Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So this idea that Germany may wake up one day and say, game over, we're done, which we said a long time ago could happen, is starting to come into the minds of a lot of people. And in fact, Angela Merkel said it during the last summit, supposedly reported on Reuters, I think yesterday or the day before. Bloomberg, I think, carried the story also, which she said that Germany is at a point where we may not stay in the euro any longer, talking out loud. And when that happens, we know we may be getting close to game over here. As we said, the core problem, just because of the nature and the structure of the European monetary system, which we won't go into, the countries that have to compete against Germany didn't, during that period when they basically had free credit and interest rates the same as Germany from 1999 to 2007, instead of taking that money and building up the manufacturing base and building their efficiency and restructuring their labor markets, a lot of the things and a lot of the discipline that Germany has done made those hard decisions to even become even more competitive. They didn't do any of that, so they became less competitive. So their labor efficiency relative to Germany has gotten worse and worse since the euro was created. And the original idea was for that efficiency to get better and better and better relative to Germany and equalize the countries. You cannot have a single currency zone when you have countries that are just so different in terms of labor and efficiencies, number one, because, again, they're locked into the same currency, and therefore any adjustments when you're locked into the same currency have to be taken domestically. So if your efficiency is so much lower, sooner or later you have to take that adjustment in your core domestic economy, and that's exactly what we're starting to see, and that's why we're starting to see the austerity hit. All that welfare state stuff is going away, as Ireland proved today with its new budget. So they don't have the currency to take that buffer, and they have to take that domestically. And this is where politically it's starting to become less and less viable, or you have fewer and fewer reasons to stay part of the euro, whether you're Germany or whether you're Greece or whatever. Each one of the politicians is coming up with more and more reasons to leave the monetary union. And that really, you could see that from the core structure from day one, and it's what Milton Friedman talked about back in 1999 when he saw this created. Mundell of Columbia, Robert Mundell, helped create this idea of the single currency. And yes, if we had correlated business cycles, correlated labor efficiencies, and correlated cultures to a degree, political cultures to a degree, a single currency zone works. This is why the idea that maybe the euro doesn't go away, but it comes back in a different form, and the form being Germany, France, Netherlands, Finland, maybe something like that. Some of those core countries that are very similar in terms of labor efficiency to a degree and can compete with Germany become the euro, and the rest of the guys just drop out and go to their own local currency, so they have that adjustment. Now that makes sense because those countries then would have a fairly common correlation in terms of their business cycles and their efficiencies. And if that were the case, the euro would probably come back and be a very, very strong currency once they discarded the southern tier countries, which would be good for the southern tier countries because then they would be able to create their own independent efficiencies and areas of competitive advantage that they can't create now because of being part of the zone. So anyway, we think the euro is in big, big trouble, and we have for a while. Came all the way down from 160, as this, we don't see on this chart, bottomed in here during the credit crunch, got hit very hard. And to us, this move up is just, kind of just an A, B, C. bigger, what we call wave 2 correction. It looks pretty standardized, and now we think we're starting down in the most, really the most vicious and strong part of a wave down, kind of what's called the wave 3 down. I don't want to get crazy with this Elliott wave stuff, but the fundamentals tend to support this, and that's how we use the wave analysis. We're not Elliott wave experts, but we look at it also in terms of the fundamentals making sense with these broader moves, which look like impulse or corrective moves, and that's the way we use it. And to us, we think the euro's in big trouble and can come apart ultimately. So obviously we're short the euro and sitting short the euro, and we'll add to the euro if it continues to fall. We definitely think the top in this move is definitely in. Could it come back to 136? Could it come back to 138? Absolutely. Could it correct even higher? Yeah, but we definitely think the top is in, given the Band-Aid situation going on in the Eurozone. And I can answer specific questions in a second on that. Aussie, we have a big question mark on the Australian dollar, and it's because of our concern about this, what's going on in China. If you look at the Australian dollar, it's or the country in terms of its growth, it's basically become a satellite of China. And when we look at China, we see so many potential warts in China and so many potential risks hitting the fan in China that if that happens, the Aussie will take the brunt of it. The Aussie is the key risk currency. The Aussie is the key premier currency from a major standpoint, from a growth and a yield standpoint. So there's very, very good reasons it's rallied, and there's very, very good reasons that it can continue to rally. If risk assets continue to move higher, if China continues to keep the music playing and grow, the Aussie will go higher despite our concerns about risk. This is the chart that we shared with our members of our service. And there's a lot of moving parts on here, but just to show you some of the, again, the pretty tight correlations here that make sense. The black dotted line is the China Purchasing Managers Index number. You can see how it came down during the credit crunch, and you can see how the Australian dollar followed it tick for tick down and got hit very, very hard. The Australian dollar is here on the left side scale, so it was approaching par, which it's made par in the U.S. dollar in this move, but it was approaching par against the U.S. dollar. Little thing called the credit crunch, which we talked about, came all the way down to around 60 cents in about 2.5 months. That was a massive fall, so you're talking about a very, very big move, and moved right on with China. China PMI up, Aussie dollar up. PMI down, some little bit of growth problems again, U.S. demand tapering off again. Now the U.S. is starting to take more and more of their exports again, running a bigger current account the last few months, and China's PMI is higher and Aussie has moved with it. As we said, this PMI will crater if the U.S. government decides to increase tariffs against China, because despite what everybody thinks about decoupling, China is more highly dependent on the U.S. consumer than they were even before the credit crunch. Another thing we watch relative to the Australian dollar is copper. And that's the one key asset class that just has as tight a correlation as anything, with the Aussie. If this green one was on here, it would look the same up here, the way it tracked. Copper, again, big move. And if you look at your copper chart today, made a new high and key day reversal today. And that's what I said today. We've had some key reversal. Aussie did the same thing. Was up about 40, 50 ticks. Ended down the same, so I think we've got a 120-point range in the Aussie today, breaking out, making an intermediate-term high, and through. Copper made a new high on a longer-term basis today, and then dropped back through in a big reversal. S&P held up a bit. But one of the points I also wanted to make here is how, on a relative standpoint, and you would see this if I had the Aussie chart against the S&P, the commodities are trading much higher on a relative standpoint because of China and this love of China, and Australian dollar being the key risk asset currency seems to have a big premium even compared to the other risk assets, is the point I wanted to make, and meaning, looking at the S&P as kind of the major depository around the globe for risk assets in general, the S&P 500. The Aussie is trading at a very, very big premium, and that is because of the growth in China.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.